Hey everybody, it's Greg Melvin again with Real Estate News in Fort Worth and Helen Penner Group Realtors. Just want to talk with you a few minutes today. Again, I just want to go over some things that you should not do when you are planning to buy a home. With a never-ending list of things that you should do when you're buying a home, it does seem kind of counterproductive to say, "What you mean? Talking about things I shouldn't do." It can be just as important as the things you should do. So anyway, real quick, I want to run over these things. Some of these will be a little bit of a overlap from one of the previous instructional videos that we did, but this is, it's important to know, and it'll help you get there faster, when you're trying to buy something. So first of all, number one is don't overestimate what you can afford. You don't want to buy a property and then you get into it, and then every month you're feeling that bind and that pressure where your payment's too high because you bought too much, in addition with your other bills that you have to pay. Now you've put more stress and pressure on yourself. So it's best to run the numbers before you actually meet with a mortgage broker. The mortgage broker will likely do a debt-to-loan ratio, meaning they'll take your monthly debt and divide it by your monthly income. And most mortgage brokers, want you to, you got to account for all your current debt, your car payment, your school loan payment, your school loan payments. Your credit card debts and any other debts you might have, and because they're going to look at your total payout every month against what your anticipated payment is when you buy a house. So a great way to track your spending. There's a lot of different apps out there that you can use, like Mint or iTab. That allows you to record your daily purchases, and that way there's a section for your bills, and you can calculate how much you're spending, and it'll kind of give you a really good idea. You want to keep your debt to income ratio below 33% or below of what your total income is. You don't want to have it'd be more than that. The one month you get a $300 cell phone bill, or your electric bill is higher than what you're used to having, and then all of a sudden now you're out of whack, and so you're putting yourself under pressure. So don't overestimate what you can actually afford. The second thing is, when you're buying a house, don't get emotionally invested in the house until you've closed on it. Because a lot of times, you can find that perfect house and you think everything is perfect about this house, and you're emotionally invested in the thing, and so you're willing to maybe pay too much for the house, or you're willing to overlook some physical issues with the house. You're like, well, we'll fix it later, and we're not going to worry about it. Well, you need to know these things going into it, and you don't want to get all emotional about it before you actually own the property, and then you've found that you wind up buying the house, and then all these things, once you're there at the house by yourself and it's yours, and you're sitting in the floor of the living room with this new house you bought, and then you start the reality of what you've moved into starts to hit you. So go into the home buying process with high intention and low attachment. It'll keep your spirits high when you're looking for that perfect place. Now, number three is don't make any large purchases. If you're thinking about buying a new car or a new set of furniture, or a new stereo system, home entertainment system, banks are going to look at your financial history, and they're going to want to see any recent activity. The mortgage pre-approval you were given is based on how much money you had in your account when you submitted the approval, and how much money you owed at the time you applied. So if you're increasing your debt, you're buying cars and all these other things, it's going to change all that, and the bank has the right, the last day or two before you close, to ask you to re-verify all your information and all that debt that you have. Now it's higher than it was, and then the bank can say, wait a minute, this is not what we approved initially. You've added more debt to it. Now your debt to income ratio is skewed, and because of that, we're not going to loan you the money. So you don't want to put yourself in that situation. Another thing is don't take out or put in large amounts of cash from your bank account. The bank financing that you have is going to flag large deposits coming in because there may be loans from another bank or another lender. Then you would in turn have to pay those back, and again, that's going to damage your loan to income ratio. If a parent or family member has gifted you part of your down payment, they're going to need you to sign a gift letter saying that that's where that money came from and that it is a gift and you don't have to pay them back. It's not a loan. So again, your debt to income ratio is not skewed. If you do, in fact, have to pay it back, then it's going to adjust your debt again. If you do happen to get a large sum of money from selling a car, or someone pays you money that is back owned, you just have to prove that money came from a legitimate source. You can't go out and just take a suitcase of money, to the closing and pay, and buy a house like that, because everybody's going to think it's drug money, or it's going to be it's not a good situation. So everything has to have a paper trail. So if you get money in your account and it comes from your parents who gave you the money or whatever, it just has to have a paper trail so that they can verify everything. And most banks are going to go back up to 60 days worth of bank statements. So it's best to get all your documentation and everything that you need prior to applying for your mortgage, and just make sure that you can account for any large withdrawals or any large deposits. Number 5, don't apply for more credit. Don't open a bunch of credit cards, all this kind of stuff as you're trying to get a loan for a house. Wait and do that after the fact, after you got your loan and you've closed and you've moved in your house. Then, if you want to open up additional credit cards or whatever, feel free to do that. But when you do it before you've got your loan closed, then the bank just looks at it as another opportunity where, okay, there's additional debt that you could add to it. And again, it's going to skew up that debt to income ratio. Number 6, another thing which is very similar to that, don't sign a loan. Don't co-sign a loan with anybody. If your brother or your sister or one of your kids or somebody comes up and they say, hey, I'm a friend of yours, I want to buy this car, but I need a co-signer. I need somebody to, I'm going to pay for it, but I need you to co-sign on it. The bank, your mortgage lender, they're going to look at that and say, well, now you've obligated yourself to another $20,000 in car debt. And so we're going to assume that you're going to wind up having to pay that at some point. And so then, again, it goes back to that famous debt to income ratio, and it's going to screw that ratio up. If it's more than 33% or so, the bank's going to say, okay, now you've surpassed that amount, and we can't loan you the money. So you're not doing, even though you feel like you're doing a favor, or helping a relative out, helping a family member out, you're not doing yourself any services by obligating yourself to an additional debt that the bank is not going to look at that very kindly. So don't do that. And again, another thing is don't finance anything. And again, we're just talking about this short period of window, over 60 days or so, 45 or 60 days, when you're trying to get a loan for a mortgage to buy a house. We're just talking about this short period of time. So just control your urges to spend money and to buy things and to finance things and to open new charge accounts and charge cards. Because you're going to have, you're going to get this new house and you're going to want to put in, you're going to get new furniture, you want to get, new appliances, that new big screen TV. But again, you can do all that stuff, but just do it after the fact, after you've moved into the house. Don't do it before, while you're still getting your loan approved, because again, it's going to mess up your debt to income ratio, and they're not. It's probably going to kill your loan, and then you're not going to have to be able to buy your house. So number 8, let's see, 8 is don't change jobs in the middle of this process. Do not change jobs, even if you hate your job and you've been there for 5 years or at least 2 years, and you've been there 2 years and you're working this job and you just hate that job, but you're trying to get a loan based on the income coming from that job. now is not a good time to switch jobs. Even if you get a fantastic job offer, or something else, or a different field, and you're like, oh, I'd just much rather do that than what I'm doing now. Just cool your jets for 30, 45 days, 60 days until you get the house loan completed, you get your house closed, you moved into it. Then if you want to change jobs, change jobs, feel free. But again, if you change in the middle of the process, the bank or the lender is not going to look on that kindly at all. They're just going to tell you that, that's a bad move, and you destroyed the process, and now you're going to have to start all over again. And it's just going to delay everything that you're trying to do, and it's just not a good move at the moment. Another thing, in the meantime, any loans that you do have, if you've got car payments, if you've got student loans, if you've got credit card payments, make sure you make all your payments on time. Make your payments on time. Don't miss any payments. If you've got good credit, it means you've been making your payments and everything like you're supposed to do. And if you make an honest mistake and you mess up a payment once, that's fine. They're not going to look at that as a killer of their deal. But again, you want to make sure that you stay on top of those things. But if you have a 30-day missed payment, that can drop your credit score by 100 points. And if the bank's got a requirement for your credit score to be 720, and you miss a payment, then all of a sudden you're at 620. Again, that's going to screw up or it's going to mess up your ability to get your loan and to get closed on that. And last but not least, number 10. What is the big thing? The number 10 thing, and it is, don't switch banks in the middle of your process. You got your account with this bank, and you're trying to get your loan through this bank, and the people at the bank, and they're the ones working on your financing for your loan. Just stay with them. If you have a bad incident with that bank and you get mad at the teller for she didn't do your deposit right or something, or they wouldn't cash this check or whatever, if you're in the middle of this loan process, just exercise some self-control, and just make yourself put that out of your mind, at least for 30 to 45 days until you get closed. Once you get closed and you've moved into your house and all the paperwork's a done deal, if you want to change banks, change banks. At that point, it won't matter. Because you need to. And also, if you're about to go into a loan for at the beginning of it, don't change banks right before that, because the bank is going to look at. If you're not using your own bank, if you're going to go with a different bank and they're going to give you a loan, they want you to see that you have statements for at least 60 days at the current, whatever bank you're at. They want to see that you have current statements. So you want to make sure that you're you can show them 60 days of transactions and account balances. Again, it may seem minor, but it can make your life a lot more complicated than it needs to be if you change your banks at the last minute. So, in conclusion, this list may be a little bit longer than you expected, but you can easily avoid a number of problems by just understanding what can affect your decision making and your ability to get financing when you're ready to purchase a new home. Getting your finances and your documents in order prior to getting pre-approval, and by getting a pre-approval prior to looking for a home, you're going to be well ahead of the game than everybody else. And then once you have your pre-approval, you'll know everything, what you need to do and what not to do, so it's still effective on closing. So that's it. Hold off on that new car. Stick with the bank you're at currently and stay on top of your bills. Your mortgage pre-approvals can be stressful and time-consuming, but it's well worth the extra effort to get you into that house you're trying to buy. So that's it for today. Thanks for watching, and we'll be back to talk to you soon. Thanks. Bye-bye.